Okay, let's unpack this. Imagine having a shortcut, like a way to see right into the most complex financial maneuvers.
Yeah, seeing how these huge forces actually move the markets.
Exactly. And finding those surprising insights hidden away in just piles of data. That's really our mission today in the deep dive.
Hmm.
Today, we're diving into, well, it's a fascinating case, and frankly, a bit eyebrow-raising. It's about alleged market manipulation by a global trading giant, Jane Street Group.
Right?
And this is all detailed in an interim order by SEBI, the Securities and Exchange Board of India.
Yeah, and what's really fascinating here, I think, is how this deep dive into the order itself just lays bare the
Nuts
mechanics,
and bolts of it.
the real nuts and bolts of high-frequency trading, and the implications for market integrity, for fairness, for everyone involved.
From the smallest trader right up to the big institutions.
Exactly. It touches everyone.
Okay, so let's set the stage a bit. Back in April 2024, some media reports surfaced, right, about a legal dispute involving Jane Street.
Yes, allegations about unauthorized use of proprietary trading strategies, specifically in the Indian options markets.
And that really sparked SEBI's preliminary look into Jane Street's trading activities.
And kick things off, yeah.
But first, maybe just quickly, who exactly is Jane Street Group?
Sure. So for context, Jane Street Group LLC, they're a global proprietary trading firm. Started back in 2000.
And they're big.
Oh, huge. Over 2,600 people, offices in the US, Europe, Asia, trading in 45 countries, a real behemoth.
Wow.
And for this SEBI order specifically, they looked at several related entities together. JSI Investments, JSI2 Investments, John Street Singapore, Jane Street Asia Trading.
They lumped them all together.
They viewed them collectively as Jane Street Group, mostly because of common control and domain association. Made sense operationally.
Okay, so before we really get into the weeds of Jane Street's actual trades, maybe we should make sure we're all on the same page about how these markets actually interact.
Definitely. It's crucial background. Let's lay out some key concepts.
Not good.
So derivatives. These are just financial instruments whose value comes from something else, an underlying asset, like stocks or indices.
Right.
And there's this fundamental link, this interrelationship between the price of derivatives, think futures and options, and their underlying stocks or indices.
How does that work in practice?
Well, think about arbitrage. If, say, a futures price for a stock gets way higher than the actual stock price.
If someone spots an opportunity.
Exactly. Arbitrageurs jump in, they'd sell that expensive future, buy the cheaper stock in the cash market, and lock in a profit. Risk-free, basically.
Okay.
And that very activity pulls the prices back into line, keeps them synced up.
So these arbitrageurs are kind of like market police, keeping things honest.
That's a great way to put it, yeah. And there's also something called put-call parity.
Okay.
It sounds complex, but it basically just connects call options and put options to the spot price and forward prices. Ensures another tight link.
Can you give a quick example? Maybe make it a bit more concrete?
Sure. Let's say a stock is trading at INR 100. Now, imagine you could buy an in-the-money call option, say the one with the 90 strike price, for just a 6 rupee premium.
Okay. So I pay 6 rupees for the right to buy at 90.
Right. So you could buy that option for INR 6. Then you could immediately sell the actual stock short at INR 100 in the market.
Right.
When the option matures, you exercise it, buy the stock at 90, deliver it against your short sale, and you've locked in INR 4 profit, 196, guaranteed.
Ah, I see. Minus costs, I guess.
Yeah, transaction costs add tiny frictions, but these, let's call them arbitrage guardrails, they keep the prices really closely connected across these different market segments.
Okay, here's where it gets really interesting for me. Why does this connection, and especially this idea of leverage, why does it matter so much on expiry day?
Ah, expiry day. That's the crucial piece, because on weekly index options expiry days, the whole game changes. Participation, liquidity.
Yeah.
It's vastly different.
Different how?
Well, look at the traded volumes. The comparable cash equivalent volume in index options can be several times higher than the combined volume in all the underlying stocks and futures put together.
Several times. Like how much?
Okay, get this. On January 17th, 2024, a key day we'll be digging into Bank Nifty options volume was 353 times the size of its cash market constituents.
Wow. 353 times.
And 98 times the size of cash and futures combined. It's staggering.
That difference in scale is just huge.
It really is. And it's not just volume, it's participants too. On that same day, Bank Nifty options had over 1.6 million unique entities trading.
1.6 million. Compared to what in the underlying?
compared to just about 4,700 in the cash market and maybe 26,000 in futures. See the difference?
Yeah, orders of magnitude. What drives that?
Leverage. Simple as that. Options offer immense leverage. A participant can get enormous exposure with very little capital down.
Like more bang for your buck.
Way more. For an at-the-money call option, you might get 100 times the leverage compared to buying the actual stock equivalent, or maybe 20 times compared to futures.
Okay, so that attracts a lot of traders.
A lot of traders who only deal in options, and crucially, they often look to the underlying index price for their trading signals.
So here's the surprising insight then. Small moves in one part of the market, like the cash stocks or futures, can create these tidal waves for profit in another, much bigger, highly leveraged segment like options. It sounds like rigging a tiny lever to move a giant boulder.
That's a perfect analogy.
So what does that mean for market integrity?
Well, it means a group with enough capital can potentially influence the underlying cash and futures markets. Maybe with volumes that seem small compared to the options market, but are still significant enough to nudge the index.
Right.
And by doing that, they could manipulate the index level to profit from their much, much larger positions in those highly liquid index options.
So they could mislead smaller traders.
Okay.
Or just engineer the closing price.
Both are possible. They could effectively create a false signal for smaller traders, or specifically engineer the closing price of the index, especially on expiry day, to maximize their own payout.
Okay, so with those market mechanics laid out, how did SEBI actually start untangling what Jane Street was doing?
Yeah.
How did they pinpoint this alleged manipulation?
Well, like any good detective story, right? They started by following the money, looking at the profits.
Profits aren't illegal, obviously, but they can be a flag.
Exactly. A useful alert, maybe, for deeper scrutiny of the trading patterns behind them.
So what did the profit analysis show?
Okay, so SEBI looked at the period from January 1st, 2023 to March 31st, 2025. Jane Street Group's total profit. A massive INR 36,502 crores. That's about, what, over $4 billion US dollars?
Huge number. But where did it come from?
Here's the kicker. Index options alone accounted for over INR 43,289 crores in profit.
Wait, more than the total profit. How does that work?
Because it was offset by losses elsewhere, they had cumulative losses of over INR 7,600 crores in other segment, stock futures, index futures, the cash market.
Wow. So the option segment was carrying everything and then some.
Massively. And digging even deeper, Bank Nifty options specifically contributed INR 17,319 crores. That's 40% of their total index options profits just from Bank Nifty.
Okay, that's an incredible concentration of profit in one specific area, especially when offset by losses elsewhere. That must have rung alarm bells.
You'd think so. So to home in on suspicious activity, SEBI identified what they called impugned trading days, basically the days under suspicion.
How did they pick those?
They ranked all trading days by Bank Nifty options profits, shortlisted the top 30, and of those 30, 19 were expiry days.
No surprise there, given what we just discussed.
Right. Then they did detailed intraday analysis on 17 of those expiry days, plus one other day. So 18 days in total got the deep dive treatment.
And which one stood out?
Well, the single most profitable day was January 17th, 2024. Profit of over INR 730 crores just on that one day.
730 crores in one day.
Yeah. And that day was chosen for really detailed examination. It revealed two distinct manipulative strategies, according to SEBI.
Okay, let's dive into that first strategy then. SEBI calls it intraday index manipulation, using January 17th, 2024 as the blueprint. What was the context that day?
Right, so January 17th, the Bank Nifty index actually saw a dramatic drop right at the open. This was due to HDFC Bank results that came out, which weren't well received.
Okay, so the market was already volatile. Walk us through what SEBI says happened next.
Okay, SEBI breaks it down into two phases. Phase I, they called the pump. This ran from 9:15 a.m. right at the open until about 11:47 a.m.
The pump. What were they pumping?
The underlying index, essentially. During this time, Jane Street Group aggressively bought up huge long positions in the stocks that make up the Bank Nifty index, across both the cash market and stock futures.
How much are we talking?
Over INR 4,370 crores worth. And they weren't just buying, they were dominating the buying. SEBI found they contributed somewhere between 15% and 25% of the entire market's traded value in most of those key constituent stocks.
Just one firm doing 15–25% of the buying. That's incredible market share.
It's huge. They were by far the single largest net buyer.
So were they buying just to deliberately move the price? Is that the allegation? Not because they actually thought the stock was, like, undervalued?
That's SEBI's contention, yes. And to understand how they push prices, you need to look at the last traded price, or LTP.
Okay, the price of the last trade.
Right. SEBI's analysis showed Jane Street placed a, quote, disproportionately high number of buy orders at or above the LTP. So they weren't just passively buying, they were actively hitting offers and pushing the price upwards.
Can you give an example?
Yeah, like in IC Spec Cash Market. SEBI calculated that Jane Street's trades alone had a significant positive impact on the LTP, pushing prices up. Meanwhile, the net impact of all other market participants combined was actually negative.
Wow. So they were single-handedly fighting the market trend, or even creating a new one.
Essentially, yes. Their aggressive buying generated this massive positive price impact on the index constituents, which directly counteracted and even reversed the collective negative impact from everyone else trading.
That's just the precision involved in these alleged maneuvers is fascinating.
It is. And check this out. There's a critical 8-minute window right at the open, 9:15 a.m. to just before 9:23 a.m.
Okay, what happened in those 8 minutes?
In that short burst, Jane Street bought over INR 570 crores worth of just the top 6 Bank Nifty stocks. These stocks make up, nearly 88% of the index weight.
So maximum impact.
Maximum impact. They single-handedly pushed prices up while the broader market, remember, was actually bearish due to those HDFC results. The Bank Nifty index itself surged over 600 points in that brief time.
Wait a minute. So they're aggressively buying the underlying stocks, pushing the index up, but are they simultaneously betting on it going down with options? Because you said Bank Nifty options were their big profit center. That feels completely contradictory.
Unless there's a specific goal, right? And that's exactly what SEBI alleges. Simultaneously, while they were artificially supporting or pushing up the index through these cash and futures purchases, Jane Street Group was effectively selling Bank Nifty via the options market. They took on large short positions.
How? By buying puts and selling calls.
Exactly. Buying put options, selling call options, and crucially, SEBI notes they entered these trades at very favorable pricing, likely because the index was being artificially held up or pushed up by their other actions.
Okay, so they create an artificial high to sell at.
That's the allegation. Their effective cash equivalent short Bank Nifty exposure through options increased by over INR 32,100 crores during this period.
32,000 crores.
Yeah.
How does that compare to their buying?
Get this. It was over 15 times the value of the long cash and futures positions they built in those first 8 minutes, and more than 7 times their total underlying buying during that whole pump phase.
That scale is just mind-boggling.
And they focus mainly on the at-the-money options contracts, because that's where the liquidity is highest.
Right.
Now, this really highlights a crucial aspect. Imagine you're a smaller trader, maybe trading options yourself. You're looking at the Bank Nifty index price on your screen.
Yeah.
You'd be seeing an artificially inflated or at least supported level, not the true market level. And you might make trading decisions based on those distorted signals. Signals created primarily by the massive footprint of just one entity.
Leading you to buy high or sell low.
Yes, making decisions based on bad information.
Okay, so that was the pump. They buy the underlying, push the index up, and simultaneously build massive short positions in options at favorable prices. What happened next?
Right, so once those massive options positions were in place, we moved to phase 2. SEBI calls this the dump. This ran from about 11:49 a.m. through to the market close at 3:30 p.m.
The dump.
Yeah.
I think I can guess what happened.
Yeah, pretty much. Jane Street Group began, quote, systematically squaring off and dumping its holdings in the underlying stocks and futures they'd bought earlier.
So, reversing their positions, how much selling?
They sold over INR 5,300 crores worth across cash and stock futures in the Bank Nifty constituents. Just completely unwound what they'd built up.
And were they dominant on the sell side too?
Absolutely. Just as they were the biggest buyer, now they were the single largest net seller. Clear market leader on the way down too.
And the LTP analysis, did that show them pushing prices down?
Exactly the mirror image. SEBI's analysis showed they placed a disproportionately high number of sell orders at or below the LTP, actively hitting bids, driving prices down aggressively.
So their impact on the index reversed.
Completely. Their price impact on the Bank Nifty index during this phase was massively negative, according to SEBI's calculation. It completely counteracted the positive impact coming from the rest of the market participants combined during that time.
Okay, so the index starts falling. What happens to their options positions?
As the Bank Nifty index declined, just as you'd expect, put options surged in value, and call options depreciated.
Which is exactly what they wanted, given their huge short position.
Precisely. It aligned perfectly with Jane Street's options positioning built up earlier. SEBI says they capitalized on this setup by selling the puts they'd bought, now valuable, and buying back the calls they'd sold, now cheaper.
Locking in the profits. So what was the final financial outcome of this whole pump and dump?
Okay, this is stark. From their trading in the underlying cash and futures markets during this reversal, the buying and then selling Jane Street Group actually incurred an intraday loss of over INR 60 crores.
They lost money on the stocks and futures trades.
Yes, about 61.6 crores loss on those underlying trades for the day. However,
Here comes the options profit.
here it comes. Their profits just from Bank Nifty index options on that single day were a staggering INR 724.93 crores.
Wow. So the 60 crore loss was just the cost of doing business to make over 730 crore. That's a bold strategy.
It certainly suggests the underlying trades weren't done for their own profit potential. And yes, SEBI's view is that this wasn't just shrewd trading. It seemed like a meticulously choreographed performance.
Yeah, the timing seems too perfect.
Right. The key insight here is maybe that a small calculated loss in one area can be seen as the cost of doing business for enabling a massive, potentially manipulated gain somewhere else. It suggests a deliberate design.
And was there anything else unusual about that day?
Yes, one more thing. To underscore just how unusual or event-specific this intense activity was, SEBI looked at Jane Street's overall gross traded value, or GTV, for the day.
Yeah.
On January 17th, their GTV was roughly 5 times higher than the previous trading day and 4 times higher than the following trading day.
So it wasn't just business as usual. It was a huge spike in activity focused on that one day.
Exactly. It confirms it wasn't just regular trading flow. It points towards specific event-driven activity.
Okay, it sounds like a highly sophisticated multi-legged strategy. But what specifically makes SEBI call this manipulation? Where exactly does that line get crossed from aggressive trading to illegal manipulation?
That's the core question, isn't it? SEBI, based on what they saw as overwhelming evidence or the preponderance of probability, concluded this was a deliberate, well-planned scheme to manipulate. They pointed to several key characteristics.
Like what?
First, the sheer intensity and scale of their intervention in the underlying markets, buying huge amounts, then selling huge amounts, combined with the rapid reversal of those positions,
Yeah.
without any, quote, plausible economic rationale other than benefiting their massive options positions. The underlying trades didn't seem to stand on their own economic merit.
Okay, what else?
Second, SEBI argued it created a false or misleading appearance of market activity. It pushed the index to levels it wouldn't otherwise have reached, potentially enticing unsuspecting traders to deal at those artificial and temporary levels.
Right, the distortion we talked about.
Third, reinforcing the first point, they stated these underlying trades were not for investment or for any other standalone economic rationale, but seemed designed only to distort Bank Nifty index option prices.
So intent matters.
Intent is key. And finally, they called it a classic case of marking the close but done intraday, aggressively moving the underlying market in their favor just before they planned to cash in on their expiring options.
Now, Jane Street must have had a response to this, right? What was their explanation?
They did. Jane Street apparently countered that these large trades in the underlying market were necessary to remove unwanted delta or manage overall delta from their broader portfolio.
Delta hedging, basically, standard risk management.
That was their claim. Delta, just quickly, measures how sensitive an options price is to changes in the underlying asset's price. Managing delta is a normal part of options trading.
So how does SEBI counter that argument? What's the difference between legitimate delta hedging and what SEBI alleges here?
SEBI's view essentially was that while managing delta is legitimate, the extreme scale, the intensity, and especially the directional pushing of prices first aggressively up, then aggressively down, went far beyond typical risk management or delta hedging.
It wasn't just neutralizing risk, it was creating direction.
That seems to be SEBI's perspective. The pattern didn't look like simply managing existing risk. It looked like intentionally creating price movements to profit from the options. In SEBI's strong words, it was an intentional, well-planned, and sinister scheme and artifice to manipulate. The intent and the market impact are what differentiated it in their view.
And there was another interesting detail you mentioned earlier. Something about foreign portfolio investors and intraday trading.
Ah, yes, that's right. The actual intraday reversal of the positions in the cash market, the selling part, was apparently conducted by Jane Street's India-based entities, JSI Investments.
And why is that significant?
Because SEBI's regulations for foreign portfolio investors, or FPIs, which Jane Street Singapore and Jane Street Asia trading would likely typically don't allow intraday trading in the cash market. FPI trades are generally required to be settled, meaning you buy today, you take delivery tomorrow. You can't just buy and sell the same stock on the same day like a local trader might.
So using the Indian entity potentially circumvented that rule.
That seems to be an implication raised by the structure of the trades, yes. Another layer to the complexity.
And this whole intraday manipulation strategy, was January 17th an isolated incident, or did they find it happen more often?
Oh, it wasn't isolated. SEBI found this pattern, this intraday index manipulation strategy, deployed across 15 different days they examined.
15 days.
Yeah.
And the financial result.
Across those 15 days, it netted Jane Street Group over INR 3,900 crores in profit just from Bank Nifty index options.
Wow.
And interestingly, over those same 15 days, their cumulative position in the underlying cash and future segments resulted in a loss of nearly INR 200 crores.
So again, the underlying trades lost money, but enabled vastly larger profits in options. The pattern holds.
The pattern seems consistent, yes. The profit engine was clearly the options market, allegedly fueled by these actions in the underlying.
Okay, so that was strategy one. But you mentioned the investigation uncovered two distinct strategies. What was the second one?
Right. The second pattern SEBI identified, they gave it another descriptive name, extended marking the close.
Extended marking the close. Can you define that for us? What does that mean?
Sure. Marking the close itself is a known manipulative practice. It's where someone places large buy or sell orders very aggressively in the final moments of the trading session.
Right near the closing bell.
Exactly. The goal is to influence the official closing price of a stock or index to benefit their own positions. This is especially crucial on derivative expiry days, because that closing price is often what determines the settlement value for futures and options contracts.
So extended just means they did it for a longer period at the end.
Sort of. It implies a more sustained, high-intensity effort in perhaps the last hour or so, not just the final minutes, aimed squarely at influencing that closing settlement price.
Okay, can you give an example from SEBI's findings?
Yeah, let's look at July 10th, 2024. This was another Bank Nifty weekly options expiry day.
Okay. How did that play out differently from the January 17th example?
Well, the timing was different. For most of the day, say from 9:05 a.m. up until about 2:30 p.m., Jane Street's activity in the underlying Bank Nifty constituent stocks was, according to SEBI, relatively muted. They weren't doing huge volumes.
Okay, quiet for most of the day. Then what?
Then, starting around 2:30 p.m. and really intensifying in that final hour from 2:30 to 3:30 p.m., their activity just spiked dramatically.
Buying or selling?
Selling this time. They sold a cumulative INR 2,800 crores worth of positions related to Bank Nifty. This included the constituent stocks in the cash market, stock futures, and also Bank Nifty index futures themselves. A broad-based sell-off.
2,800 crores in the last hour. What kind of market share did that represent?
Again, huge. SEBI noted their traded volume just in the stock futures segment during that final hour accounted for more than 35% of the entire market-wide total traded value in those futures.
Over a third of the market in the final hour. Just them.
Yeah. That strongly suggests, as SEBI put it, time-bound strategic execution, not random selling.
And the LTP analysis, did it show aggressive selling?
Yes, very clearly. The data showed a clear pattern of aggressive selling below LTP across multiple heavyweight Bank Nifty stocks.
Forcing prices down.
That's the implication. For example, in HDFC Bank cash segment trades by Jane Street in that last hour, SEBI found around 92% of their trades were at or below the prevailing LTP, resulting in a negative price impact. Similar patterns were seen in futures. This sudden emergence of directional high-intensity sell-side activity in the final minutes, SEBI argues, indicates a deliberate strategy to push the index lower into the close.
Okay, so they're aggressively selling the underlying assets into the close. What were they doing in the options market simultaneously?
This is where it connects. For most of that day, Jane Street had maintained a relatively neutral delta position in their Bank Nifty options.
Meaning they weren't heavily betting on a big move up or down.
Right, relatively balanced, but precisely coinciding with when they started that aggressive selling in the underlying market around 2:30 p.m.
Yeah.
SEBI observed a sharp buildup in negative delta in their options positions.
Negative delta. That's a bet on prices falling, right? Buying puts, selling calls again.
Exactly. They started making a very strong directional bet that the Bank Nifty index was going to fall, right as they were allegedly pushing it down themselves.
How big was this shift in their options bet?
It was substantial. Their net negative delta exposure, their effective short position, increased from around INR 27,200 crores at 2:30 p.m. to over INR 44,100 crores by the market close. That's a shift of nearly INR 17,000 crores towards a bearish bet, just within that final hour.
So just to connect the dots, this coordinated action, selling the underlying aggressively while simultaneously building a huge bearish bet in options, this allowed them to essentially engineer a soft close for Bank Nifty, push it lower right at the end.
That appears to be SEBI's conclusion, yes. Pushing the index lower directly increased the profitability of their now disproportionately large outstanding bearish options positions, which SEBI estimated at that INR 44,153 crores level by the close.
So it looks like it was aimed squarely at maximizing their profit right at the settlement point.
It certainly has that appearance. The timing and coordination are key.
And did the trading volume spike again on this day, like on January 17th?
It did. SEBI noted that on July 10th, 2024, Jane Street Group's total gross traded value was approximately 4 times higher than the previous day and 1.5 times higher than the following day.
So again, not normal trading flow. Very expiry-centric activity.
Exactly. It reinforces the idea that this intense activity was specifically targeted around the expiry settlement.
And this extended marking the close strategy was July 10th the only example?
No, SEBI observed this pattern on 2 other Bank Nifty expiry days as well during their investigation period.
And the outcome?
Across those 3 days where they identified this pattern, it contributed to a total profit of INR 560 crores for Jane Street Group.
Okay, so 2 distinct strategies, both allegedly manipulative, both highly profitable, especially in expiry days. What's truly remarkable, though, and maybe concerning, is that this apparently wasn't just a one-off discovery that stopped. There's evidence of this behavior continuing even after they received regulatory warnings.
That's perhaps one of the most striking parts of the SEBI order, yes.
How unusual is it for a firm of this size, like Jane Street, to get such a direct warning from a regulator or an exchange acting for the regulator and then seemingly disregard it?
It's certainly a strong action by the regulator, and you'd expect a firm to take it very seriously. On February 6th, 2025, the National Stock Exchange, the NSE,
India's main stock exchange.
right, at SEBI's instruction, the NSE issued a formal caution letter directly to Jane Street, Singapore, and JSI Investments, the Indian entity.
A caution letter. What did it actually say?
It was quite explicit. SEBI quotes parts of it in their order. The letter warned Jane Street against maintaining abnormally high delta positions in index options.
Okay.
And it specifically mentioned that their large directional OI, open interest, basically the size of their directional bets, was causing risk to market stability and raises concern for market integrity.
Wow, that's pretty direct language. Risk to market stability.
Very direct. The letter went on to state that such activity, quote, prima facie appears to be fraudulent and manipulative and, importantly, cannot be considered as coincidence.
So they were explicitly told, this looks like manipulation, it's not random, and it's a problem.
Yes. And the letter concluded by advising them to exercise caution and refrain from taking large open positions, delta, and to refrain from aforementioned trading pattern. A clear instruction to stop.
Okay, a very clear warning shot fired in February 2025. So what happened after that? Did the pattern stop?
Well, according to SEBI's findings,
No.
despite that clear warning, fast forward a few months to May 15th, 2025. This was a Nifty weekly options expiry day, not Bank Nifty this time.
Okay, different index, same expiry dynamic.
Exactly. And on this day, SEBI observed Jane Street Group, quote, to continue to run very large cash equivalent positions in index options. And crucially, they were seen intervening heavily again in the underlying market near the close, this time in Nifty futures and the futures of Nifty constituent stocks.
So the same pattern again, even after the warning. Was it the same strategy? Selling into the close.
Similar tactics, but with a twist. Unlike the bearish strategy seen on July 10th, selling to push prices down, the May 15th activity showed a bullish variant of extended marking the close.
A bullish variant. So they flipped the script, but used the same alleged manipulation playbook, buying to push prices up this time.
Precisely. They adapted the direction but maintained the alleged strategic intent.
Okay, walk us through how that May 15th strategy unfolded.
So similar structure. For most of the day, say 9:05 a.m. until about 1:26 p.m., their trading was relatively passive, muted.
Then the action started.
Then from about 1:26 p.m. through to 3:25 p.m., just before the close, they began accumulating large, effective long cash equivalent positions in Nifty options. This time, buying call options and selling put options a bet on prices rising.
Okay, building the bullish options bet. What about the underlying market?
Simultaneously, during that same time frame, 1.26 p.m. to 3.25 p.m., SEBI observed aggressive and large-scale buying by Jane Street in Nifty index futures and the futures of key Nifty constituent stocks. And again, the pattern was buying at or above the prevailing LTP.
Pushing the Nifty index higher into the close.
That was the result, yes. The Nifty index closed at a higher level, which, according to SEBI, allowed Jane Street to profit from their even larger bullish options positions they had built up.
Can you give a sense of the scale of that buying near the close?
Yeah, SEBI provides examples. In that roughly 2-hour window from 1.26 p.m. to 3:30 p.m., Jane Street's trading volume in the stock futures of Nifty constituents surged to nearly INR 5,000 crores.
Almost 5,000 crores in 2 hours.
Yes, and again, representing a disproportionately large market share. For instance, in HDFC Bank futures, their buying was over 22% of the market-wide volume in that period. In Reliance futures, almost 22%.
Huge shares again.
And their buying in the Nifty Index futures was over INR 2,500 crores, which was nearly 25% of the total market-wide volume in Nifty futures during that closing period.
Wow. So the key takeaway here is that even after being explicitly cautioned by the exchange, acting on SEBI's instructions, they allegedly continued the same type of activity, just flipping it from bearish to bullish depending on their options position.
That's what the evidence presented by SEBI strongly suggests. A persistent pattern, adapting its direction, bullish or bearish, but maintaining what SEBI viewed as the underlying strategic intent, influencing the closing price via heavy intervention in the underlying market to maximize gains on very large options positions.
It really does raise serious questions, as you said, about respect for regulatory authority and, well, fair play in the markets.
It certainly puts those questions front and center.
Okay. So, after unpacking these two detailed strategies, the intraday index manipulation and the extended marking the close, and seeing the alleged persistence, what are the broader implications here for you, our listener, and for the financial markets overall?
Well, I think there are a few key takeaways. The first, and maybe the most fundamental, is just understanding how interconnected these markets are. How activity in the underlying cash and futures markets, even if it looks relatively small compared to the options market, can have these massive amplified effects in the highly leveraged derivative segments. That leverage is a double-edged sword.
Right. It magnifies gains, but also the potential impact of manipulation.
Exactly. And that leads to the second point. The potential for what we call information asymmetry.
Meaning some players know more than others.
Or, in this case, some players might be creating market conditions that others aren't aware of. Large, sophisticated players might generate these temporary distortions, pushing prices up or down artificially. That smaller, less informed traders who are just looking at the price on their screen are completely unaware of. And that can lead them to trade at unfavorable artificial prices.
Trading on a false signal, basically.
Precisely. Third, it really highlights the constant challenge for regulators. Sophisticated trading strategies like these, operating across multiple market segments, cash, futures, options, and often across different legal entities.
They're hard to track and police.
They definitely cross traditional boundaries and require very sophisticated surveillance and analysis to detect and understand. It's an ongoing cat-and-mouse game.
So what's the bottom line for someone listening to this?
I think the bottom line is the importance of critical thinking. In today's world, we're overloaded with financial information and data. This case is a stark reminder that not all market movements are organic. Not everything you see is just pure supply and demand at work.
Sometimes there might be a hidden hand trying to orchestrate things.
Potentially, yes. You need to be aware that these kinds of complex, potentially manipulative strategies can exist.
This whole deep dive has really peeled back the layers, hasn't it? Showing just how intricately connected these different market segments are. And how, even seemingly small actions in one place can have these colossal impacts somewhere else.
Absolutely.
It genuinely makes you think differently about the signals you might be seeing in the market, especially around those volatile expiry times.
Indeed. And maybe that leads to a final important question for you, the listener, to consider. How might understanding these types of sophisticated, multi-pronged strategies, these alleged manipulations, how might that change the way you perceive sudden market movements or sharp price swings, particularly around expiry days? It really invites you to look beyond just the surface price action, to maybe start asking what could be the why behind the what forces might be at play underneath.
A really important question to keep in mind. Definitely food for thought. Well, join us next time on The Deep Dive as we continue to try and simplify the complex and bring you those nuggets of knowledge that help you stay truly well-informed. Thank you so much for joining us.